What if every single morning, before you even opened your eyes, money was already flowing into your account? Not from a second job, not from a lottery, but from businesses you own. This is the reality for dividend investors. And by the end of this video, you are going to know exactly how to make it yours. Let's start at the foundation. What exactly is a dividend? When a company earns profits, it has two choices. It can reinvest that money back into the business to grow, or it can share a portion of those profits directly with shareholders. That cash payment to shareholders is called a dividend. Think about it this way. You own a small slice of a giant pizza company. Every time they sell pizzas, you get a cut of the profits just for owning your slice. You didn't have to make the pizza. You didn't have to deliver it. You simply own part of the business, and the business rewards you. Dividends typically get paid quarterly. That's 4 times a year. Some companies pay monthly. And the most elite dividend payers have been increasing their payouts every single year for decades. These aren't rare unicorns. Companies like Procter & Gamble, Johnson & Johnson, and Coca-Cola have been paying and growing dividends consistently for over 50 years. They're called dividend aristocrats, and they are the gold standard of passive income investing. The metric investors look at is called the dividend yield. Here's something that Wall Street doesn't advertise. The majority of the stock market's long-term returns haven't come from stock price appreciation. They've come from dividends. Research going back to 1926 shows that dividends have accounted for roughly 40% of total stock market returns. When you reinvest those dividends, which we'll talk about shortly, that percentage climbs even higher. Consider this. $1 invested in the S&P 500 in 1926 without reinvesting dividends would have grown to about $233 by recent analysis. But that same dollar with dividends reinvested would have grown to over $4,000. Same stocks, same time period. The only difference was what you did with the dividends. The great investor John D. Rockefeller once said, "Do you know the only thing that gives me pleasure? It's to see my dividends coming in." And he built one of history's greatest fortunes doing exactly that. This is why dividend investing isn't just an income strategy. It's a wealth-building strategy disguised as income. Now let's talk about how you actually pick great dividend stocks, because not all dividends are created equal. There are 4 key metrics every serious dividend investor tracks. Number 1, dividend yield. This is how much you earn relative to what you pay. A yield between 3 and 6% is generally considered healthy for most dividend stocks. Anything above 6 or 7% should raise eyebrows, because that high a yield often signals that a stock price has dropped because the company is in trouble. Number 2, payout ratio. This tells you what percentage of profits the company is paying out as dividends. A payout ratio under 60% is generally safe. The company has room to sustain and grow the dividend. A ratio above 80 or 90% means the company is barely holding on, and a dividend cut could be coming. Number 3, dividend growth rate. The best dividend stocks don't just pay dividends, they increase them every year. A company that has raised its dividend 10% per year for the past decade is compounding your income automatically. 10 years from now, your yield on your original investment will be dramatically higher than when you first bought. Number 4, balance sheet strength. A company needs to be financially healthy to keep paying dividends. Look at its debt levels, its cash flow, and its free cash flow specifically. That's the cash left over after running the business. If free cash flow comfortably covers the dividend, you're in a strong position. The stock screener is your best friend here. You can filter the entire market for companies that meet every single one of these criteria in just a few minutes. This is where dividend investing becomes genuinely life-changing, and most people completely miss it. It's called a dividend reinvestment plan, or DRIP, and it might be the single most powerful wealth-building mechanism available to everyday investors. Here's how it works. Instead of taking your dividends as cash, you automatically reinvest them to buy more shares of the same stock. More shares means more dividends next quarter. More dividends means even more shares, and the cycle accelerates. This is compound interest made real and tangible. But instead of numbers in a savings account, you're watching your share count grow, and with it, your income stream. Let me show you the math. Suppose you invest $10,000 in a dividend stock with a 5% yield that grows its dividend by 7% per year. Without reinvesting, after 20 years, you'd be earning about $500 a year in dividends on your original investment. With DRIP, that same $10,000 becomes a machine that generates nearly $2,000 a year, 4 times as much. And your investment itself would be worth significantly more. Warren Buffett understands this deeply. His holding company, Berkshire Hathaway, collected over $6 billion in dividends in a single year, mostly from companies he bought decades ago at far lower prices. The dividends he receives now dwarf his original purchase prices. That's the power of patient dividend reinvestment. Now, how do you actually build this portfolio? Let's make it concrete. Step 1. Start with broad exposure. Before picking individual stocks, consider a dividend ETF like the Vanguard Dividend Appreciation ETF or the Schwab U.S. Dividend Equity ETF. These funds hold dozens of top dividend payers, instantly giving you diversification and steady income. They're the perfect foundation. Step 2. Add sector diversity. Dividend stocks cluster in certain sectors: utilities, consumer staples, healthcare, and financials. These are businesses that generate steady cash flow regardless of economic cycles. Owning stocks across multiple sectors protects you if any single industry hits a rough patch. Step 3. Focus on dividend growth. Not just dividend yield. A stock yielding 3% today that grows its dividend by 12% per year will yield over 9% on your original investment in just 10 years. That's not income, that's a compounding machine. Step 4. Reinvest everything, especially at the beginning. The early years of dividend investing don't feel exciting because the income amounts are small, but this is exactly when reinvestment matters most. Every share you accumulate now will be paying dividends for the next 20, 30, 40 years. Step 5. Be patient and protect the portfolio. Avoid the temptation to chase the highest yields. Avoid selling during market downturns. In fact, downturns are when you want to be buying dividend stocks at a discount. And never ignore the fundamentals just because a yield looks attractive. Here's the truth about dividend investing that took Warren Buffett, Peter Lynch, and John Templeton decades to prove. Wealth isn't built through luck, timing, or stock tips. It's built through ownership, patience, and the relentless power of compounding. Every dividend payment you receive is a business working for you. Every reinvested dividend is a step toward a portfolio that generates income whether the market is up, down, or sideways. The best time to start was 20 years ago. The second best time is today. If this video helped you see dividends differently, hit that like button right now. Subscribe to Market Map for weekly deep dives into stocks, dividends, and investing strategies that build real wealth. Turn on notifications so you never miss an episode. The market is always open. Your future is waiting. Let's build it together.